Hello and welcome to the lecture for the first part of Chapter 11. This chapter deals with accounts receivable, notes receivable, and revenue. So all of the elements of the revenue cycle. So that starts with getting an order from a customer, fulfilling that order, billing the customer, and then receiving payment. So that's really important because for a couple of different reasons. One, it's the core purpose of most businesses. It's why they exist. Getting orders, fulfilling them, and getting paid for them. So that's one reason it's important. The other reason that it's important is that this is an area where auditors need to have kind of a higher level of concern because of the nature of these accounts. Revenue is such a high profile figure on a company's financial statements, and there's a lot of pressure, of course, for every company to show growth in revenue, that it's an area where companies are more likely to, take shortcuts or put their thumb on the scale, kind of manipulate things in a way to continue to show growth in revenue where there might not be. So that, coupled with the fact that receivables is a very important asset on a company's balance sheet, and companies also want to overstate receivables. So the fact of having an asset that tends to get overstated and revenue that also tends to get overstated means that this cycle is particularly important for auditors. So some sources of receivables in general. One is claims against customers for the sale of goods or services, or trade receivables is another term for that. That's usually a fairly large item on a company's balance sheet in most cases. Another source could be loans to officers or employees. The key thing there is disclosing those. Those are by definition related parties, so it's important that all of that is disclosed to readers of financial statements. Loans to subsidiaries usually don't get addressed in audits because they're canceled out in consolidations. And usually if we're auditing a consolidated entity, one company's receivable is going to be offset against another company's payable. If you're auditing a subsidiary, however, and it hasn't been consolidated, then that would of course be a factor, and it would be a loan to a related party. You could have claims against other kinds of refunds. Those might be monies due back to you from other entities. It might be settlements in lawsuits. It's important to keep in mind here that they can't be contingent. So the fact that you believe you're going to win a lawsuit and be awarded money isn't enough to book it. We can't book positive contingencies for reasons of being conservative. So if a judgment has been issued, that's another matter. That could be a receivable. There could also be claims for tax refunds, or there could be advances to suppliers. And here I want you to kind of remember back in Accounting 201 where we talked about unearned revenue. So if I'm selling a product and I receive money from a customer, I'm going to debit cash and I'm going to credit a liability, unearned revenue. Well, if I'm the customer, I'm on the other side of that. I'm going to credit cash and I'm going to debit a receivable. So rather than debiting and having a negative account payable, I'd have a receivable. So any money I've advanced to suppliers should be recorded as a receivable. Now it's important that all of this is shown as net realizable value, and that takes into account whether or not the allowance for doubtful accounts is sufficient. So that's of course based on estimates from management. So as an auditor, we want to look at that carefully and make sure that that it's being done in an honest and straightforward way. So sources of notes receivable. Again, a note receivable is a more formal type of receivable evidenced by physical documents, i.e. a promissory note. So those could be substantial loans to individuals or companies. And again, we as an auditor would want to see documentation of that. It could be an installment note or contract for the sale of goods. So if we have large sales, those might be financed through a payment scheme with a customer. That would have to be documented. There could be loans, again, to subsidiaries or other related companies that would take the form of a note, or larger loans to officers and employees. Sometimes companies will want their officers to own shares in the company, so they think more like owners, and many times they will loan the officer or the employee money in order to buy the shares from the company, and that would be included as a note receivable. And then, of course, the sale of a division of the company would also be included here. The important thing to think about in note receivables, because they're generally spread over a longer period of time than 1 year, there may be current and non-current elements of a note receivable. So how that's categorized could be important and could lead to needing to do reclassification entries to get that correct. Some of the audit risks for receivables. So there have been a lot of fraud involving the overstatement of receivables and revenues. One, because of the high visibility of the revenue figure and the pressure to show increased revenue. I've worked in companies where fraud has occurred with regard to receivables and revenue, for sure. And then oftentimes there are people in the company whose compensation is tied to revenue. Sales managers, vice president of sales, those types of people. So having an understanding of that and knowing what kind of pressures might exist that would cause that to happen would be a key component of assessing audit risk. There may be a risk associated with having fairly complex revenue recognition issues in a company, depending upon the complexity of their sales and how their sales are structured. So looking at that is important. Understanding what the industry rules are about that would be important. And then the fact that receivables and revenues are sometimes subject to estimates. And again, estimates would be an issue in determining revenue if there are revenue recognition issues, or in terms of receivables, primarily talking about collectability here. So the audit for receivables, the audit objectives for receivables is to get an understanding of the client so we know what the inherent risks are, including fraud risks of this category. We want to get a good understanding of their internal controls. And when we look at the risk of material misstatement, because we're dealing with assets here, we're primarily concerned about the existence. So are they, do all of the receivables they claim on their balance sheet actually exist, and did those revenue transactions occur? So when we're worried about something existing, about it, the potential for it being overstated, we're going to look at the audit trail from the direction of starting with the general ledger and working our way down to documents. So start with the detail behind the general ledger figure and then seek confirmation with documents on each of those numbers rather than the other direction. It's important that we look at the cutoff for revenue transactions. Again, it's very typical for companies to try to pull January 2nd and 3rd shipments into December to boost their yearly sales. The issue about whether or not a client has rights to the recorded receivables, here we're dealing with making sure primarily two issues. Finding out, has the company factored their receivables? So have they received early payment for somebody stepping into their shoes with those receivables so they don't have right to receive that money? The other issue might be consignment sales. So if the company is basically parking inventory at a customer's lot so that when the customer sells it, they can get paid, that's not a sale. It's just moving inventory from one location to another. It wouldn't be evidenced by a purchase order from that reseller as an example. So that would be another example that, the receivable doesn't actually exist. Proper valuation, again, is going to be contingent primarily upon revenue recognition and bad debt, allowance for doubtful accounts rather, and then proper presentation and disclosure is important, making sure that they are indeed current assets. So I want to go through some typical kinds of documents that you would come across as an auditor in reviewing this transactions in this cycle. The first on the left there is a purchase order from a customer. It'll have a unique purchase order number. In this case, it's in the upper right corner. Keep in mind that every company is going to have their own purchase orders. They're going to look differently. Some might be on paper, some might be electronic, but it's basically going to contain the information saying we would like to buy the following from you, a date, what the terms are, and then what the products are and the prices are willing to pay for those. Once a company inputs that customer's purchase order into their system, it'll create a sales order. So that's a document that's an internal document within the company that we're auditing. It may have a sequential number associated with it, and that's telling the rest of the company, we just got this order, now let's act upon it. Let's order these products, manufacture these products, whatever the case is. So the important thing there is that it contains a credit approval. So what is the process for indicating that credit approval? Who does it? Who has authority to do it? When is it done? Those are questions that we would want to ask as an auditor. The next document on the left is a bill of lading. That's effectively a contract with a trucking company or a common carrier to take goods from your location to the customer's location. So it describes not necessarily the individual products, but what packages that carrier is taking and where they're taking them to. The key information here is the date. So the date is going to determine whether or not we can invoice the customer for this shipment on that date. So it's a key cutoff document. So once the bill of lading is turned in, indicating that the product is shipped, the next step is to prepare a sales invoice. So that again is going to have a sequential number as well. All of these documents do. And that invoice is what's then sent to the customer. Notice that it references the customer's purchase order number so that the customer can match that up with their purchase order so that they can pay promptly. The last document is really important. This document is a credit memo, so it's a document from the seller to the buyer reducing the price for some reason. So it could be a discount for because the goods were substandard in this case. It could be that there was a mistake or it showed up late, so we're giving the customer a reduction. What's really important about this document is who is able to issue it. It's important that the person that's able to issue a credit memo doesn't have anything to do with invoicing or cash receipts. The reason for that is if somebody could divert a cash receipt, say in this case the customer sent in $550, I pocket that $550 and then I issue a credit memo which shows the customer owes that much less. Now, if you go to confirm the balance with this particular customer, it's going to agree and you would be none the wiser. So the key issue here is who is able to issue these, what are the procedures required to issue that, and making sure that that's done correctly. So an overview of the audit procedures for the revenue cycle. One is to get an understanding of the client and their overall environment. Talk about each of these more on upcoming slides. Getting an understanding of internal control, so doing that either through questionnaires or through flow charts and interviews. Determining what the risk of material misstatement is, that's going to influence the further procedures and who we have working on those on our audit team. Then we're going to perform further audit procedures, starting with testing the controls, making sure they're working as designed. And then secondly, doing substantive procedures where we're actually looking at source documents, contacting customers directly to verify balances, those kinds of things. So to break out A a bit further, to obtain an understanding of the client and their environment, we want to understand what types of products they sell or what types of services they sell. How are those sales generally structured? Do they sell to different classes or categories of customers? And do those customers have different terms associated with them in terms of payment terms, prompt payment discount availability, volume discounts? What are the kind of rules associated with how they interact with their customers? You want to understand if the business is a seasonal or has cyclical demand. So if it's, you'll know if there's a dip that it's something anticipated versus something that could be more concerning. You want to understand what all of the company's policies are, and these should be in writing. So you should be able to request these sales policies. They should be able to give you a copy of that so you can determine if people are actually adhering to these policies. Some would be about how products are priced, how we deal with sales returns and discounts, how we go about the process of extending credit to a customer and determining the amount that's appropriate, who does that and how do they do it, and then what is the normal delivery and payment terms. So what is generally the production cycle from when we receive an order to when we deliver the order? So we can look for anomalies to that normal term. We want to find out if anybody in the company has compensation arrangements that are based on recorded revenue, and we want to know who those people are and what the arrangements are. The reason for that is we want to find out if any of those people are involved in any of those policies. For example, if somebody is extending credit that also gets a bonus on recorded revenue, that could be problematic, which could cause us to maybe dig a little bit deeper in this cycle. And then find out what the typical revenue recognition principles are in that particular industry. You probably in Accounting 301 talked about percentage of completion method for large construction companies. So there's a common way that revenue recognition is handled in that industry, and it would be important to know that so you know your client is conforming with that. So that's the end of the first part. I look forward to talking to you in the second part of the lecture for this chapter. Thank you.